Hey everybody, Lee Lowell here, smartoptionseller.com. How's everyone doing today? It is Saturday, August 15th, 2020. Thought I'd try a different screen recorder today. You can see my face down here at the bottom left-hand corner so you know what I look like now. Hey, on these videos, we like to do our Saturday synopsis. We like to take a look at the charts, see what the market's done over the past week, and see what the market may do in the week moving forward. We also like to give some good options information, some free options information. This week, we're actually going to go over part 2 from last week's Netflix put option credit spread. Got a lot of questions that came in last week about the spread, so I want to go over that a little bit more. So I will go into a little bit more detail. So let's hit it. Let's go to the charts and see what happened over this past week. We always look at the SPY, which is the exchange traded fund for the S&P 500. And what have we seen this past week? Here's the week's worth of trading right here. This little bit of trading right here. We've got the summer slowdown. Range is getting tight. Even though we keep moving higher, the ranges each week has been getting smaller and smaller, real tight ranges. And look at this. S&P 500 almost took out the all-time high that we hit back on February 20th, 2020. Let me draw a little line here so we can see how it looks. We got the top right here, getting ready to make this double top or actually blow right through it. S&P 500 looking strong, keeps going up, wants to take out the all-time high. We talked about this last week. Long and strong, been hugging the 20-day moving average, the blue line here, looking pretty good. Really no reason for this thing to stop moving. It will hit resistance right around 340. That's where the top is. And today, yesterday I should say, Friday, August 14th. Yes, yesterday hit a high of closed at 336 and change. So we've got a couple little resistance, couple points up here. So it's definitely going to tag it next week. I'm pretty sure of that. And will it blow through it? Will it blow through it and keep on going to new all-time highs? We shall see. But the path of least resistance is higher. Let's take a look at the NASDAQ, which we don't have to tell you has been the strongest of the three indexes we track, the NASDAQ, the Dow Industrials, and the S&P 500. It really is hard for me to believe that we've really gone this high and this strong based on the economic numbers that are coming out around the world. But the stock market moves to its own beat. And also like the S&P 500, it has been hugging the 20-day moving average. This week or the end of last week came down. And what day was this? This move was on the 11th. So actually just a couple days ago. That was this week. Came down very close to the 20-day moving average. We talked about it last week. When the market comes down to the 20-day moving average, it's been a good buy every time. Bounced right here and ended up the week up here. So NASDAQ is still strong. I would think we'd get some kind of more meaningful pullback, but no, it wants to stay along the 20-day moving average. So if you're in it, good. Stay strong, stay long. Market wants to keep going up. I really see nothing derailing this at the moment unless something really bad happens with the coronavirus. So those vaccines are being worked on by a lot of companies. The market is being optimistic. It is looking out ahead. So the NASDAQ, just like the S&P 500, is strong, making new highs almost every week, new all-time highs. Let's take a look at the Dow Industrials. What has it done? Ever since it popped above the 200-day moving average here about a couple weeks ago, it has just gone on a nice tear. Look at that. From 26,000 all the way up to 28,000. 2,000 points in a couple weeks. Pretty good. Dow still has a little ways to go until it gets up to its all-time highs here, hit back in February. But it's looking pretty good. Making this, looks like it's making a little bit of a bull flag pattern right here. You got the flagpole, which is the move up. Little pennant right here, this little pennant. Usually the move after that is up higher again. So we got a little potential bull flag here, move up higher. It wants to take out the all-time highs. Look for the Dow to keep going up, up, up. So that's it. The market looks strong, wants to keep going up. Take a look at the VIX once again, as we always do. Volatility indicator keeps coming down, moves inversely to the general market. Market goes up, VIX comes down. It is well below all of its moving averages here, trying to come back down to its long-term lows of between 10 and 15%, was in that range for a very long time. So it's moving back down, moving inversely to the general market. As long as the market keeps going up, VIX will go down. Option premiums are getting cheaper. That means option buying strategies are decent at this time. Still expensive comparative to where it's been for a long time. It's at 22% right here. It had been creeping in between 10 and 15%. So volatility is still a little high, even though it's come down. But it's working its way lower again. So that's the VIX. What have we seen some stocks this week? Let's take a look. We know that, I don't know if I talked about Intel last week. Intel just had a massive drop. Earnings came out. So up at $62 a share, dropped all the way down to about $47 a share. That one hurt. I was thinking Intel was in this range here, and then it just got hit to the downside. So I'm not interested in picking bottoms here. This is going to meander around here for a while. So Intel's down in the dumps. Conversely, its ugly stepsister, which is not ugly anymore, is AMD. This is a chart of AMD, and it's just powered higher at Intel's expense. Intel goes down, AMD goes up. So we love Intel. We've been selling lots of puts on Intel, put spreads, doing real well with AMD, I should say. So we like AMD. It's looking strong, keeps going up. Cisco was another stock that made some moves this week. Unfortunately, it got dropped to the downside on its earnings. I thought it was actually going to pop through this resistance line. It was moving along. Moving averages were going higher, looking good. I was waiting for this thing to pop through this little resistance, but unfortunately earnings took over and dropped it down. So it is out of play right now. Cisco, unfortunately. What other stocks do we have? Amazon is still, doing well, hugging the 20-day moving average line. And looks like it's kind of coiling in pattern here, sitting right on the 20-day moving average line. Have to believe the next move is going to be back up higher. And along with that, we look at Apple. Apple's just been a monster since it's had its earnings announcement, and it announced a 4-for-1 stock split, which takes place at the end of August. Apple, all-time new highs, just going up. I mean, why fight it? If you want, get in on Apple, get in on the long side. I mean, this is crazy. Just keeps going up. And lastly, we look at Tesla because they also announced a stock split, 5-for-1 stock split. Once they announced it, there it goes, powering higher. Anyway, so market is strong. One stock we talked about the other week was Kodak. Mentioned that for whatever reason, the U.S. government gave Kodak, yes, a film company, almost $800 million to create a vaccine for coronavirus, I think, or doing some other, creating some other biopharmaceutical drugs. And it was, $2.50 for forever. Look at it all the way along here. And all of a sudden, pops up to $60 a share. Word got out there, some shady business happening inside of Kodak. So it drops back down. It's down to $8.50 a share. That's just bad manipulation right there. I don't like to see that. People get hurt buying on the upside, and then all of a sudden it comes down. Lots of manipulation. Don't like to see that. So that's it for the market analysis this week. Market remains strong, wants to keep going up. I don't really see anything derailing it. NASDAQ is the strongest of the three. So keep watching the 20-day moving average line and play along with it. If it comes back down to the blue line, 20-day moving average on your charts, could be a good place to get long. The QQQ, triple Qs it's called, is a way to play the NASDAQ. So you can do that same way as the SPY. We do that for the S&P 500. And if you like the Dow, you can play the DIA, the diamonds they're called. DIA tracks the Dow Industrials. It's the exchange traded fund. Has the same exact movement of the Dow Industrials. So there you go. So what are we going to do today? Talk about options trading. We're going to talk about part 2 of our Netflix trade. Talked about a put option credit spread last week and got some questions about it. So we want to go over that a little bit more. So Netflix, let's open up the chart here. We talked about Netflix. We had in our smart options seller, in our newsletter, the vertical spread trader, we sell put option credit spreads. We had done a credit spread put option credit spread on Netflix back in June. We talked about this June 10th. We sold a put option credit spread, had been hugging the, this is the 50-day moving average line here, this red one. The blue line is the 20-day. Had the pullback, was hugging along the 50-day moving average, felt like it was a good time to get in. The moving averages were sloping upward, which is what we like to see. So on June 10th, we sold a put option credit spread, which is a neutral to bullish strategy. And a month later, on July 13th, which was the top of the line here, we got out on the highs. How about that? So we bought on June 10th, sold out the spread, bought the spread back, I should say, on July 13th. When you sell a put option credit spread, you sell the spread to open, and when you close it, you buy to close. You buy it back. So we sold it on June 10th, bought the spread back on July 13th. And so the questions were coming in, why did we take this trade? Why did I choose the strike prices that I chose? And what are the risks? What are the rewards? So we want to go dive a little deeper into the details, the numbers. So back in June, when we put the spread on June 10th, so that was right around here, somewhere in here, we sold the 305 300 put option credit spread, which means we sold the 305 put and bought the 300 put against it as a spread, and we collect the premium, which is the price between whatever we sold the 305 puts for, and we subtract that from the 300 puts that we had to pay for. That is the spread. That's what we collect as our premium. And so why did I choose the 305 and the 300 strikes? Well, typically when we sell put option credit spreads, we like to make sure that the distance between the current stock price to the sold option of the spread has at least a 20% cushion. So what we do is when we want to find the cushion amount, what we do is you take the current price of the stock. So on June 10th, the price of the stock was about $431, and the sold strike of the spread is the 305 strike. So you subtract 305 from 431, and that gives us an amount of $126 of cushion. Okay, and you divide the 126 by the current price of the stock of $431. That gives us a 29% cushion from where the stock is now all the way down to the sold strike of the spread, which is a $305 put. So we like to have a lot of cushion. A lot of cushion means the stock can move up and down and meander around, and we don't have to worry about things because our strike price is all the way down here at $305 a share. A lot of people like to sell spreads or put options, that strike prices that are more close to the current price of the stock. That's not what we like to do. We like to sell put options and put option spreads way out of the money here, all the way down here. And the reason why we do that is because we like to give the stock the opportunity to make its normal gyrations without scaring us out of the trade. Sometimes stocks could dip, you get scared out, you have to buy the spread back, and you lock in a loss. We don't have to worry about that because our strike's all the way down here. And I don't think there's any chance that Netflix is going to fall that far. So we like to choose spreads that have at least a 20% buffer between the current price of the stock and the short leg of the spread. We look for minimum 20%. In this case, we got 29%. So we got even more than what we wanted. And in addition to that, we try to get at least a 25-cent credit when we sell the spread on a $5 wide spread. 305 strike minus the 300 strike is $5. That's a $5 wide spread. So we always look to get at least a minimum of 25-cent credit. And what did we do? Well, when Netflix hit its high on July 13th, that spread decayed in price. We sold it for 25 cents a spread, and the spread value went down. That's what we want to see. When stock prices go up, put option values go down. That makes the spread cheaper. So we bought the spread back for 3 cents. We talked about this last week. We sold the spread to open at 25 cents a spread, and then we bought it to close, bought the whole spread to close for 3 cents, locked in a 22-cent per spread profit, and that's how we do it. And let's go back to the document that I had discussed last week that talked about the spread a little bit, what we did. June 10th, we sold the spread for 25 cents a spread. The stock was at $431. And let's talk a little bit about the margin requirement again and how we figure out the numbers, profit, loss, and all that. Whenever you sell a spread, an option spread, you're required to hold certain money aside in your account. That's called a margin requirement right here, margin requirement. And the way you figure out the margin requirement is the difference between the strike prices we talked about is $5 wide, and that would be a $500 margin requirement, and you subtract out the $25 that you received. 25 cents per spread is actually 25 actual dollars. So your margin requirement per spread is $475. If you sold 10 of these spreads, you'd have to keep $4,750 in your account on hold at all times. And that is a limited risk, limited reward trade. The most you can make when you sell a spread is what you sell the spread for, 25 cents per spread. The maximum you could lose is the same thing as the margin requirement, $475. So you're risking $475 to make $25. I know that seems out of whack. Most people want to pay $25 to make $475, but we do it in reverse. We risk $475 to make $25. And why do we do that? Because the probability of us winning on the trade is so sky high, typically 95% or greater, that we will win on the trade, meaning we will get to make a profit on the trade. In this case, we made a $22 per spread profit. Probabilities are very high that we will win on the trade. And so in order to figure out the return on that trade, you always have to divide the profit amount, which is $22, and you divide that by the margin requirement of $475. It's 4.6% return in 1 month, annualized at 55%. So you're doing pretty good selling these put option credit spread. Now, one thing we like to talk about is what's the break even? Like, where do people ask me, well, what happens if the stock starts moving around? What's the break even? So the break even is you always have to calculate you take the short strike of the spread. In this case, that's the $305 strike, and you minus out the credit that you receive for the spread, which is 25 cents. So that equals $304.75 is your break even price on the stock. Okay, so if Netflix goes down, oh, my typing's really horrible. If Netflix goes down to $304.75, that is the break even on the trade. If it expired on expiration day at $304.75, you will break even on the trade. We actually like to see the stock not go down to that price because we want the stock to go up. It's a bullish trade. We want the stock to go up, not down. But just in case, let's go back and look at the chart. Look at this. Let's go back. Say this was June. Where are we? Okay, so right around here was June 10th. Was right here. So let's just back it out so we can see what it actually looked like at the time of the trade. And a couple more days here. Okay, so this was around June 10th or so. So this is what I saw on the charts. Got in here. And so at $431 or so, that's where Netflix was at the time. We have this cushion all the way down to $304.75, all the way down here. So I had a pretty good idea that Netflix was going to keep moving up, wasn't going to come all the way down here, and we can see what happened. Just start moving ahead, and Netflix started to go up. Came back down. It's actually come back down to the 50-day moving average line. So I don't know. Netflix could be another candidate for another put option credit spread. So once again, what do we look for? We look for a 20% cushion between the current stock price and the strike price that is sold, the sold leg of the spread. You got a sold leg and a purchase leg. And so we like a 20% cushion. We like to get at least a 25-cent credit for a $5 wide spread. And we typically like to go out a few months in time, anywhere from 2 to 5 months out in time. With volatility being so high these days, we've been able to do these 2 to 3 month spreads, and we're able to take them off after about a month. So we're doing pretty good with these spreads. So there you have it. That is how the Netflix put option credit spread work. This is how I look for stocks that are a nice uptrending chart. Moving averages are sloping upwards as well. You want to look for strong stocks that are moving upwards. You don't want to try to pick bottoms on stocks that are moving lower because those stocks probably keep going down. So you look for uptrending stocks that is what we like to do. Same thing when we sell naked put options in our Smart Option Seller newsletter. So there you go. That is the part 2 of the Netflix put option credit spread. Great way to make some money in an uptrending market. Just make sure you pick strong stocks. And so lastly, what we like to do is go back to our website, smartoptionseller.com. Once again, you can download our Put Selling Basics free guide here. It talks all about put option selling. And in our services tab, we just talked about the Vertical Spread Trader newsletter. That is what we do in Vertical Spread Trader. We sell put option credit spreads, and in Smart Option Seller newsletter, we sell naked put options. If you don't know what those are, we can always talk about it one-on-one coaching. All right, that is all for me today. Everyone have a great weekend. I hope you have a great week ahead. And don't forget to like and subscribe on the YouTube channels. Give me a thumbs up. Send me an email. Love to hear from you. And that is all for me today. This is Lee Lowell signing off.